Hello, I'm Sally Burdett. Welcome to Global Business Europe. Our top stories. Protectionism does not make you more competitive. China's message to the United States over the ban on foreign-made humanoid robots. Global markets struggle to recover from the huge tech sell-off. South Korean shares plunge as chip maker SK Hynix disappoints. Microsoft and Meta earnings out in just a few hours. Will they steady investor nerves or fuel another sell-off? And keep your hands off our game. Europe kicks back at FIFA's plans to sell stakes in the World Cup. China says it strongly opposes a US ban on imports of foreign-made robots. The Trump administration says the restrictions will cover advanced machines, including humanoid and four-legged robots, citing unacceptable risks to national security, many of those, of course, made in China. Our correspondent Huang Ye reports from Beijing.
China has opposed the United States' recent announcement of a ban on imports of humanoid robots. Even though the announcement did not mention any country, China has already become a major player in the global robotics industry. Briefing the media here in Beijing earlier on Wednesday, Chinese Foreign Ministry spokesperson Mao Ning said such move is an overstretching of the concept of national security, calling it targeted Chinese companies.
China firmly opposes the U.S. overstretching the concept of national security and going after Chinese companies. Protectionism does not make the U.S. more competitive and will only hurt the interest of U.S. companies and consumers. China will continue to do what is necessary to firmly defend the legitimate and lawful rights and interests of Chinese companies.
Technology has been a point of contention between China and the United States in recent years. The U.S. has imposed restrictions on Chinese tech companies, including Huawei, and tightened control on advanced semiconductor exports to China. But at the same time, the two countries have continued their economic and trade talks. Just 2 months ago, Chinese President Xi Jinping and U.S. President Donald Trump held talks here in Beijing, and Chinese Foreign Ministry said the two sides have reached important common understandings on keeping economic and trade ties stable. But now it seems the advanced robotics may have emerged as another technology issue between the two countries. Huang Ye, CGTN, Beijing.
Well, let's bring in our correspondent, Jagriti Dave, who joins us from Washington. Jagriti, just give us more details on exactly what they're clamping down on with this ban.
Yeah, Sally, this particular ban is on foreign imports of humanoid and quadruped robots. And this is a ban that the FCC is saying specifically on new products entering the market. As you say, the FCC does not mention China, but 85% of the four-legged robot market is, the market share is held by China. So this really does give the US a bit of a leg up in the industry as it tries to race with China in this area. It also is restricting on new power inverters. This is technology that connects solar panels to the grid or to data centers. And this is really part of that race that's seen the US make a ban on things like new drones, again, from China. And this is an industry that is forecast to bring in billions and billions of dollars in revenue. And so I think the US is saying that their concerns are around things like the ability for surveillance on ordinary Americans to happen, but also for hacking of these robots to take place. And under these concerns, the US is affecting these bans, which of course is affecting China, and China's saying that this is an unnecessary step that is exaggerating the risks and denies any of the cybersecurity threats that the United States say could be posed.
It's really interesting, Jagriti, that even within the US tech sector, there's disagreement on this sort of protectionist closed-off system versus being open. Mark Zuckerberg from Meta is saying that curbing Chinese AI is a bad idea.
Yes, he is in an interview with the Financial Times warning of something called regulatory capture. So this is the idea that regulations put in place to protect consumers is actually going to do them a disservice by giving too much power to small groups, to invested interests, notably the tech companies. And this follows calls by tech companies like Meta to promote open models of AI AI as opposed to just closed models. So this is where open models allow ordinary people to take key components that are available to them from the models, download them and adapt them. People say this could pose, again, those sort of similar security risks that we've been talking about. But, you know, people like Meta are sort of saying that actually this democratizes AI and also means that people can learn from AI. Any vulnerabilities are more easily captured because they're more widely known rather than in the hands of just a few people. There's also obviously those worries about the recent hack that an open AI model escaped human control and was able to hack a startup, and those sorts of concerns are at play here. But at the same time, people like Meta and other AI companies, including Anthropic and AI, are calling for more independent and international oversight of AI, saying that perhaps AI models development needs to slow down to make sure that there is a more consistent vetting in place that's not sort of restricting AI, but also not allowing AI to develop so rapidly that it gets out of hand.
All right, thank you so much. That's our correspondent Jagruti Dave in Washington. Global markets are struggling to recover from a deepening technology sell-off. Wall Street slipped lower, dragged down by chip stocks, which have now fallen for 4 straight sessions. Pressure's building as investors question whether the huge sums poured into AI will actually deliver the returns expected, while growing competition from China adds to concerns. And Asian markets also hit hard. South Korea's benchmark Kospi index closing around 6% lower. The fall driven largely by chip giant SK Hynix. Now, despite reporting record quarterly results, its shares plunged almost 10%. Investors worried that the AI boom may not be moving fast enough to justify sky-high expectations. Joined now by Matt Maley, Chief Market Strategist at Miller Tabak. Matt, thanks so much for your time. Record profits for SK Hynix, but shares are dropping. Why is that?
Well, Sally, it's something we've been seeing, for the last several weeks, almost 2 months now, in the semiconductor, the chip sector around the world. I mean, we saw it last month with both Broadcom and Micron here in the U.S. We also saw it with Samsung earlier this month. Taiwan Semiconductor, again, that was about a week and a half ago, and now SK Hynix. It's just that the expectations were so high, priced for perfection, so that if you get any kind of, I guess my point is, even the ones who reported great numbers and great guidance, they've gotten hit. So the ones that have reported, something lower than expectations, they're getting hit even harder.
Is there something more at play with Kospi, though? Because in the last few hours, South Korea's finance minister has been apologizing, suggesting there's more than just the global tech sell-off at play.
Well, there is to a certain degree, because there is that added leverage we see in South Korea, not just from these leveraged ETFs in the tech sector, but also the single stock leveraged ETFs. And, whenever you have leverage, it's funny, leverage can add and help the market go a lot higher, but then, it works in both directions, and that's what we're seeing. So they're starting to make some moves to kind of take away some of that leverage. That will hopefully help things stabilize. But when you have excess leverage, and a lot more than we have in most other parts of the world, it exacerbates the moves.
Yeah, and South Korea's finance minister holding that emergency meeting earlier in the day. Some of the trading rules have changed, but we've seen 3 interventions from the government since June in South Korea. Do you think that this latest intervention will actually make a difference?
Well, it's always hard to know, when that will happen, to see the absolute bottom, because there is a lot of leverage in that system. So just because they're discontinuing or clamping down on future leverage, that doesn't mean that people still don't have some that will need to be unwound. But, what I'm looking at right now in the Kospi index is watch the 5,000 level. It's just a little bit above 5,000. That's where it bottomed a couple of weeks ago and bounced. I'm sorry, that's where it bottomed back in March and bounced. And so that should provide some good support. Keep an eye on that over the next couple of days. If we break below that, it's going to create some real problems. But what they've been doing recently, that should provide some good technical support.
Does this have a lesson in terms of inherent risks when a country stock exchange is dominated essentially by two companies. Samsung, SK make up about 40% of its value.
Yes, Sally, that's definitely a problem. And I hate to say it, but it's also a problem in the U.S. We don't have just two companies, but, you just notice that the Mag 7 names make up about 35% of the S&P 500. So there's a few more names, but it's still highly concentrated. And, so it's a situation where people need to be very careful, and it makes it much, much harder for people to see rotation, because when these key stocks go down, the indexes go down because they're so highly weighted, and that takes away a lot of confidence in the marketplace.
Well, thank you so much for speaking to us. Matt Maley, Chief Market Strategist at Miller Tabak. Well, this huge global sell-off comes ahead of key earnings reports from some of America's biggest tech giants. I'm joined now by our correspondent, Kate Fisher, in Washington. Hello, Kate. So what are investors expecting?
Well, they're going to be looking very carefully as to whether these huge investments in artificial intelligence made by these tech companies are actually translating into revenue. And you're right, there are four huge tech giants about to announce those earnings. They are Microsoft, Meta, Amazon, and Apple. And investors looking at slightly different things for each of them. With Microsoft, they'll be looking as to whether the AI investment is translated into faster growth for its Azure cloud, and whether adoption for Copilot has increased. When it comes to Meta, they'll be looking at whether ad performance has improved, and how the guidance they give on what they intend to spend on AI infrastructure. When it comes to Apple, the iPhone demand resilience, particularly in China, how is that faring? And Apple as a whole, have spent less on infrastructure when it comes to artificial intelligence than other big tech companies. So they'll be looking at that. When it comes to Amazon, a look at whether its web service has benefited from AI cloud demand. I think the real key question here is investors looking at whether it has been worth these companies putting all those billions of dollars into AI investment. Is it resulting in returns on their investment? And because they make up such a huge part of the S&P 500, this will be, really informative for investors when they're making future decisions.
And Kate, I understand you have a little bit more information about the story we heard last week for the first time, when it was basically an AI system going rogue, taking matters into its own hands. Tell us more.
Yeah, that's right. We're getting more details now from Hugging Face, the company that was the main target. And it suggests that it wasn't just the only target, that it also tried several others, and that it was rogue across the internet for 4 days. Basically showing that this was a sustained attack. The number is 17,600 hacking actions over a number of days. And also the thing that analysts are now saying from this extra information, the worrying thing is that this wasn't just, this rogue agent wasn't just able to expose holes in cyber security defenses, but it was able to connect all of this without any human interaction. And that is the striking thing about this. It was able to perform this sustained hack over several days without any human being involved. And that is the first time that there has been evidence of this happening.
Wow, 4 days, 17,000 hacking actions. That's a big worry. Thank you so much, Kate Fisher in Washington. In other news, Apple briefly hit a market capitalization of $5 trillion for the first time on Tuesday, just a day after overtaking Nvidia to become the most valuable publicly traded company. Shares of the iPhone maker have jumped 25% so far this year. Its quarterly results are out on Thursday. Oil prices have surged around 6% after President Trump said the U.S. will hit Iran hard in retaliation for an attempted attack on American forces. Brent crude is up to $90 a barrel. Saudi Arabia has joined the U.S. targeting groups based in Iraq, which they say are backed by Iran. All of this, of course, raising fears that the Middle East conflict could further escalate. China's called for deeper cooperation in service trade, green transition and renewable energy with the UK. Commerce Minister Wang Wentao made the remarks during a video call with the new UK Trade Minister Jonathan Reynolds. Wang has also called for a resolution on protecting Chinese companies in Britain. Reynolds said stronger bilateral trade relations would benefit both. eBay and former executives have agreed to pay $56 million to a couple targeted in a harassment campaign. David and Ina Steiner published a newsletter critical of the multinational e-commerce company. Prosecutors say former executives sent them threatening items, including a mask covered in pig's blood and a book on surviving the death of a spouse. This is Global Business Europe. Still ahead. Is luxury regaining its luster? Hermès posts a rise in quarterly sales, but is it enough to reassure investors?
Everything is a business story.
Welcome back to Global Business Europe with Sally Burdett. The headlines. Protectionism does not make you more competitive. China's message to the US over the ban on foreign-made humanoid robots. And global markets struggle to recover from the huge tech sell-off. South Korean shares plunge as chipmaker SK Hynix disappoints. Now, the luxury goods sector has been hit by weaker China demand, higher prices and cautious consumers. But is it finally turning the corner? Hermès reported stronger second quarter sales revenue, rising 6.7% on the same period last year, around $4.7 billion. Growth driven by France, Japan and the Americas, while easing tensions in the Middle East also helped. But the results did little to reassure investors about the pace of the wider luxury recovery. Particularly in China, shares are down more than 11%. LVMH, owner of Louis Vuitton, Dior and Fendi, reported second quarter sales over $22 billion, up 3% from a year ago. Those shares pretty much flat, ending the day around 0.5% lower. Kering, however, struck a more optimistic note. Shares are up over 16% after Gucci delivered better than expected sales, lifting first half revenue to around $8.2 billion. That is a 1% increase on last year. Strong demand in the United States for its latest handbag collections helped offset weaker spending elsewhere. Sebastian Huber is a luxury researcher joining me now. Sebastian, just explain, it seems like a bit of an anomaly what we're seeing in the luxury sector.
Well, yes, we see both a recovery to some extent, but not just as much as investors expected. So when we look at LVMH especially, I think there was bigger expectations and just some consensus now that there's a stable situation ahead of us, but not as promising as the previous years used to be. So that leaves investors with a worry towards the upcoming holiday season, which is the most important season for the luxury industry as it is.
So if we look across, I think it's the big four, Hermès, Kering, LVMH, Richemont, who's actually getting it right?
Well, I think there's very different groups to compare in regard to their exposure to different markets and different categories. LVMH is very diverse, both in geography and in its various segments, from jewelry to fashion to spirits, and therefore the picture is a bit more diverse, whereas Hermès maintained a very strong foothold in maintaining brand relevance, maintaining a very clear positioning with consumers all around the world, and therefore is gaining more from this rebound than LVMH, which may need to bring up to speed each of its categories, each of its divisions, and each of the markets one by one.
You also look at trends. Why is jewelry having a moment?
Well, in times of uncertainty, jewelry is seen as an investment and therefore has more appeal than fashion, which comes in faster cycles. Also, jewelry has a bigger share of high net worth and ultra high net worth consumers that usually spend pretty much independent on the current situation and circumstances. So it's both an investment and a slightly different clientele that attracts jewelry more than fashion. On the other hand, fashion can also cycle back much more quickly with the right design, the right brand desirability and the right services around it. Some of the brands are prone to turn the ship around.
China and the US dominating this market. So how much do they differ in terms of what they want?
Very much. I think the China macroeconomics are different from the US, and also the role of local brands is quite different. So if we look again at LVMH, Tiffany being a US brand with a strong US clientele and good macroeconomics has benefited more in the recent quarters than some brands in China, where some of the consumer behavior is still lagging behind expectations, where also the recent price frenzy, especially in handbags, but also in some of the fashion items, has scared customers away, and they're more conscious about the value that they get from the luxury products that they purchase.
Well, thank you so much. Sebastian Huber is a luxury researcher.
Thank you.
Now, football's world governing body, FIFA, is planning to sell stakes in the World Cup. The proposal has prompted strong responses, including from UEFA. Now, here's our correspondent, Siobhan McCall, who has all the details. Hello.
Hi, Sally. Yes. FIFA says it wants to launch something called FIFA Forward Enterprise, or FFE, which would sell its commercial rights, including tickets and deliver tournaments like the World Cup. External investors would be able to buy minority non-controlling stakes in FFE, and FIFA could raise more than $4 billion from this. A company launched by the brother of Donald Trump's son-in-law is expected to lead the investor group. FIFA President Gianni Infantino says the plan will allow FIFA to increase funding given to member associations from $8 million to $20 million over the next few years. They can invest this in infrastructure, grassroots development and coaching. So what's been the response? Well, Europe's governing body UEFA has been very vocal, accusing FIFA of trying to sell the soul of football. It's set to hold an emergency meeting, and plans could include a boycott of the next World Cup. Several confederations said they were blindsided by the announcement, including Asia's, which says there should have been comprehensive prior engagement before the announcement. And this is not the only controversy involving FIFA recently. There were concerns over high ticket prices and the commercialisation of mandatory hydration breaks at the World Cup. And UEFA boycotted the final after Donald Trump revealed that he had called Infantino to get a red card for the United States for Lauren Balogun suspended so that he could play in their last 16 match. To go ahead, the proposals require a majority vote of above 50% from the 211 member associations. Dan Plumley is senior lecturer in sport finance at Loughborough University in the UK.
And we can draw parallels here with perhaps the failed European Super League attempt a few years ago. It seems to have certainly kicked off in the media. I'm surprised probably it's taken this long to reach a kind of statement like this from FIFA. Everything we know about the game has suggested a move towards more commercialisation. This is, of course, a very controversial one, but it was always, I guess, likely to happen at some point where there is money to be made from some of the prize assets of world football.
You mentioned that failed European Super League a few years ago. There was a really strong reaction to that, and that brought it down. Do you anticipate something similar here?
I think it's possible we could see that. Obviously, early stages so far. I think FIFA will hold firmer than perhaps the European Super League did. I think we're likely to see a more bullish approach from them moving forward in the coming days and months. But it's certainly not beyond the realms of possibility that this could collapse, as you say, linked to the backlash that we've seen so far.
FIFA says this will help increase funds for grassroots development. And there's also reports that there would be a $20 million one-off incentive for the member associations who vote to go ahead with this. Now, surely some of them, perhaps the smaller member associations who need that money, will be inclined to vote positively.
That is absolutely the case, and FIFA will point to that if you look at the finances of it and the predictions that FIFA are talking about. If those predictions are hit, if this were to go through and those numbers are hit, as you say, the uplift for member associations that don't have access to that sums of money normally would be huge. And, you know, again, we're looking at this through a European lens, and we're talking about UEFA and some of the bigger member associations. But to some of those smaller ones, that amount of money is huge. And if FIFA can almost guarantee that revenue for them cycle on cycle, and there is an uplift, you can absolutely see why some of those member associations would vote for it. And that's going to be one of the interesting subplots here as we move through.
This is the latest in a series of controversies surrounding FIFA. How damaging is all this to its brand, and does it care?
Well, I think the timing of this is interesting in that regard, as you say, because, of course, we're just off the back of a Men's World Cup, but probably, again, the biggest we've seen in terms of your FIFA's revenue cycle. They're going to report record revenues for the cycle, but we've seen controversy follow that event from start to finish, and some of that has been political. Of course, the situation with the USA men's player and the red card, some of it's linked to the Super Bowl-style halftime shows and the hydration breaks, but all of those things, the hydration breaks particularly, have brought with them added commercial value and benefit for sponsors and broadcasters, and that's where we go back to the money. And I think these things are often, as always, tied up in that monetary argument, that there is always good and bad PR that comes with these things, and FIFA have certainly been on the wrong side of some of that with some of the things that have happened with this World Cup. But ultimately, the money is what we're talking about here, and you can see, again, when those kind of numbers are on the table, it is understandable in the kind of cold business sense of why some of these things happen, and football has certainly become more commercialised in the last 20, 30 years or so. You know, we've seen that move forward at a phenomenal pace.
FIFA has set a deadline of September 19th for the football federations to accept the plan, so we're likely to hear more about this story over the next few months. Back to you, Sally.
Thank you so much, Siobhan. Your headlines once more. Protectionism does not make you more competitive. China's message to the US over the ban on foreign-made humanoid robots. And global markets struggle to recover from the huge tech sell-off. South Korean shares plunge as chipmaker SK Hynix disappoints. And that's it for Global Business Europe. Thanks so much for watching. More on all our stories at europe.cgtn.com, and do follow CGTN Europe on Facebook, Instagram and TikTok. And you can go to CGTN Europe's channel on the Telegram app, scan the QR code on the screen to get stories, updates sent direct to your phone. Up next on CGTN is Africa Live. We'll see you again tomorrow, same time, same place, from all of us here in London. Goodbye.